last count. Manoj Singla is joining in. He is the Managing Director and Co-Head Research at Religare Capital Markets. Manoj, thanks very much for taking out the time. Let's go straight to the two big numbers that came out yesterday. Divergent opinions, even commentary-wise, from both the managements, fairly different in what they have to say for the trajectory going forward and the environment going forward and what they'll do.
Yeah, hi. So obviously, I think this is not the first time this has happened. I think it's been happening for now at least 3 to 4 quarters in a row, where Infosys continues to disappoint and give a tough demand outlook, while TCS continues to beat numbers and basically talk of things being okay. I think from our perspective, if you look at the tech demand environment globally, the demand environment is indeed tough. And I think if you look at the tech companies reporting globally, more companies are talking on the tough demand environment side. So I think what's going to happen is, I think demand environment is tough. I think more companies on the tech side are going to miss and beat numbers. However, there's always going to be pockets and select companies who continue to deliver even in a tough environment. And I think TCS falls on that side.
Would HCL Tech too fall in that category? I mean, those numbers also watched out very keenly with the kind of outperformance that they generally deliver.
Yes, I think HCL Tech has been another company which has been delivering numbers decently. If you look at their commentary, what they gave last quarter was that while demand environment is tough, they have won a number of large deals in the last few quarters, and that should help them to keep up growth. So I think HCL Tech numbers would be better than Infosys, though I don't think they'll be better than TCS. So I think somewhere in between these two companies.
Would it call for a re-rating of the industry right now, Manoj, looking at how things, maybe not now, maybe 1 or 2 quarters down the line, if things continue like this?
Yeah, see, I think if you basically look at industry multiples, the contraction has already happened, right? Except for TCS, which continues to trade at a significant premium to the industry. I think most of the other stocks in the industry, whether it's Infosys or Wipro or even HCL Tech, and especially some of the mid-cap players, a lot of them are trading at significant discount to their last 5-10 year averages. I think this is partly to do with one, I think as the companies have become bigger and demand environments have become tougher, I think your growth rates have indeed come down. And secondly, I think obviously people are worried about how the whole global thing is going to pan out. Even if you get some resolution on Greece near term, I think the fact is Europe is going to remain a very tough market. So I think people are generally worried on how the whole outsourcing environment is going to play out. And therefore multiples have gotten compressed and the de-rating should continue. So I think from a top-down perspective on India and from a strategy perspective, we think that tech should be an underweight in portfolios at this point in time.
Just one last question on this particular issue. Within individual companies there, what are the favorites and what are looking like laggards? Obviously, keeping in mind the results also that have come from Religare.
Yeah, so I think within the industry, clearly I think TCS stock will continue to hold up, while despite valuations are on the higher side, I think they continue to deliver. I think Infy and Wipro, we think will continue to be laggards in this space. I think there will be select mid-caps in this industry which I think will deliver numbers quite well and will continue to lead. I think Hexaware falls in that league. I think Mindtree will have a decent quarter, and I think Mahindra Satyam will have a good quarter. So I think those three, I think we've singled out in the mid-cap space as ones which will do well. I think a lot of the others would probably be laggards in this market environment.
Manoj, hi, good morning. Prashant this side. You've downgraded TCS to a hold. Is that looking at what Infosys has delivered? And you find it inconceivable that while one continues to grow very healthily, the other kind of seems to be in some sort of a decline? At least temporarily. Is that the reason why you're bringing down, and of course valuations as well? My point is, it's the market that we have seen for the last 2 years has been extremely polarized. Some things which are trading with very high valuations have continued to gotten more and more costlier. So why do you think, are you saying that will change, or what's the call here?
Yeah, so I think, Prashant, a large part of the downgrade is more valuation-led. I think in terms of whether TCS performance will catch up with Infy, I think to be very honest, most analysts, including me, have been waiting for that to happen over the last 3 quarters. It's not happened. In fact, the gap in performance has continued to increase. And if we look at the management commentary, at least for the next quarter, I think the gap will still be there. So I do not expect TCS numbers to weaken significantly, at least not for September quarter. I think the thing that is more worrying less than Infosys performance is the industry overall, because if I look at the technology demand environment globally, and if I look at some of the even the hardware companies, what they are saying, if you look at what's happened in US from a number of companies like AMD, I think everybody is saying tech demand is weak. So while I don't think that TCS numbers will weaken to the extent of Infi, the fact is demand environment is weak, and therefore TCS should see some weakness just because demand environment is weak. But I do think it will not happen in September quarter. That might be seen only in the December quarter. And I think add to that the fact that valuations on TCS TCS is anywhere between 17-18 times earnings for a company which is still growing at 14-15%. So valuations are just completely out of whack. Having said that, I think the big thing on TCS is given lack of options in tech, and tech is a fairly large sector in terms of index weight, people might continue to flock to TCS. So I don't expect the stock to fall, but I don't think it can go up much from here simply because of valuation. So that's why it's largely a hold in our portfolio. But at least for the near term, I think TCS will definitely hold up better than Infosys.
Okay, and Infosys maybe is a study in contrast valuation wise. I mean, so TCS might not outperform handsomely because of where it is trading, and Infosys might not continue to be in a free fall because of its valuations, which aren't very expensive. But I guess the valuation game is, or the justification that Infosys will do well because valuations are low, I think is getting weaker and weaker, that argument. Manoj, I'm going to get to your specific areas of interest in a bit. Let's just talk about the market broadly. What's your call? Are hopes too high in the market? Expectations that the new guys, not actually the old guys, but in charge of new ministries, Dr. Singh in charge of the finance ministry, will turn things around, etc. Are hopes just running too high?
Yes, I think what we have seen is we have seen a market rally in anticipation of lots of things happening, and I think what happens every day you get some new news. I think for yesterday, I think the news doing the rounds is we'll get a diesel price deregulation after the presidential elections. So I think in a way a lot of hope is discounted into the market, and I think if those hopes do come through, if you really get some reforms, obviously the market will move up higher. But if those reforms don't happen, the market will fall down. So I think we are in a tricky phase with the fact being that some of these so-called reforms are already priced into the current into the market currently. So we really need to see reforms for the market to hold up where it is. If we don't get those, I think the market will again correct in August.
Manoj, but how do you think about it? I mean, so okay, reforms won't happen, so market will fall. But what is your own call? Do you think that these expectations are just way out of whack in that sense, or do you think they're justified, or are people very knowingly playing the game that okay, prices will run up a little bit, we know not very much is going to happen, but we'll get out? I mean, so it's a very it's a game which people are playing knowingly. Yes.
Yeah, I think it's a tough market. I think if you step back and look at the market, what's happened in the last year and a half, I think the economic environment for India has become tougher and tougher, partly because of global issues and partly because obviously of what we call the policy paralysis within India. I think even if you were to get some reforms, even if you were to get some rate cuts, the fact is I think India's economic growth is not going to recover back in next 1 or 2 quarters. I think to go back to 7-8% growth or whatever the magic number is, I think we are at least 3 to 4 quarters away. So I think economically we are going to remain in tough times, at least for calendar 2012 in my view. Which is why I think the market will continue to trade in a range. I think if it gets too optimistic and if Nifty moves up to 54, 5500, I think that's a point you should try to get out. If it goes down below 5000, I think that's a point when one goes down and starts to long into Nifty, because I think that's going to be a trading range for India, because even in the worst case for India is growing at 5%, which is not bad on a global basis. But for the market to re-rate up significantly, you actually need reforms, and therefore only then the market can go up below 5500 or so. So effectively, I think what I'm saying is this is a trading market. You need to basically trade the levels and be there. I don't think we're going to see a significant breakaway in either direction, at least not for the next 3 to 6 months.
If you say that the market is primarily looking for reforms, Manoj, I mean, would you give significant importance to data points like IIP numbers, which came out yesterday, 2.4% for the month of May from a negative figure, and then again you've got the RBI credit policy coming up on the 31st of July, which everyone's watching out for keenly?
I think interestingly, IIP at 2.4 for May is actually better than April, right? So in a way, one could argue things are re-accelerating. Interestingly, the way the market is, that's taken as a negative, because if growth is re-accelerating, you might not get a rate cut, which people are anticipating on July 31st. So I think the fact is, whether it's 2% IIP, whether it's 1% or 3%, they're really low numbers in India's context. And I don't think you can expect the IIP number to re-accelerate significantly given what we're seeing around us. I don't think we're seeing too much of investment activity to justify a very high number. The other thing interesting to watch out for government data is these get revised downwards. If you look at the number for April, it actually got revised downwards, right? So is this 2.4 number the actual number? We don't know. I have a sense you might see a downward revision on this when you get the next IIP number as well. So the fact is growth is weak, and while we can bounce from a very low base a little bit up, I think economically things are going to remain weak in India unless we really get signs of either rates coming down significantly or some real good reform.
All right. We'll come back to that, the expectations about the RBI policy, and get your views on that as well, Manoj. But we've got market pre-open in just about. Manoj, let's get back to you. I mean, expectations from 31st of July, what the RBI could do?
Yeah, I think, as I said, the IIP growth was 2.5%, which actually will reduce the chances of rate cut. I think the key number is to watch out on Monday when we get the inflation number. I think consensus is hovering around 7.5, 7.6%, and I think the key number is to watch out for the core inflation number. The core inflation number, if it comes significantly below 5%, I think we can have some chance of a rate cut. But if core inflation is also on the higher side and the overall WIP inflation remains around 7.6, 7.7%, there's a reasonable chance that RBI might not cut rates this time. I think the other thing to watch out for is there's a huge expectation that post the presidential elections, we might see some reform either in terms of diesel deregulation or something else. So if something was to happen between the 20th of July and 31st July, which basically indicates movement by the government towards the reform process, or something on the subsidy, which basically means that your deficits in India can come down, that might prompt the RBI to start loosening a little bit. So I think the data points that will come out in the next couple of weeks are going to be critical towards RBI's decision.
In fact, there were talks of FDI and retail as well kick-starting post the presidential elections, because of which most of the retail stocks just a week back started to rise in trade. Manoj, let's come down to your portfolio now. Any changes there from what you've been concentrating earlier on with stocks like Ashok Leyland, Yes Bank, Union Bank of India that were major concentrations on those portfolios?
Yeah, I think incrementally what's happened is, given that growth continues to remain weak, I think we are also thinking that one should move a little bit more towards a more defensive portfolio. So I think we are saying that one could, even despite the significant outperformance, get back a little bit into some of the consumer names, some of the consumer mid caps, which have not done so well. As you said, some of the retail names where I think if you get any movement on FDI and multi-brand retail, some of the retail stocks could do well. So I think a little bit more defensive, but also playing a little bit more of event-driven stuff, where we think something could happen and therefore things could move up. I think on the bank side, we continue to like Yes Bank, although I think we don't like Union at this point in time. Our view is we should stick more towards Axis Bank, ICICI, SBI. I think those continue to be our favorites on the banking side.
A few other interesting, names that you like. I mean, aside of the ones that we spoke about, there's a Page Industries that you've maintained a hold on. You want to highlight that for us?
Yeah, see, I think there are a lot of stocks in the mid-small cap space in India that one can look at, where I think growth continues to remain pretty strong, and which I think are consumption-led stories. A lot of these companies have very high ROEs, very good cash flow characteristics. So something like Page fits into that category, and this is a company which I think will continue to grow anywhere between 20 to 30% CAGR over the next 4 to 5 years. Very good margins. This is Page Industries, good margins. It basically has strong ROE. So I think while I think we have a hold on the stock because the stocks run up and we think the stock will consolidate over the next 3 to 6 months, but for someone with a 2 to 3 year view, there are stocks one should buy and hold. Anywhere with the liquidity on these names, I don't think someone can trade in these stocks. So these are stocks which one buys and owns and keeps it from a 2 to 3 year perspective, as in they're very good companies to own from a 9 to 12 month horizon, from a 2 to 3 year horizon.
Manoj, that was Page Industries, right?
Yeah, that's correct.
Yeah, okay. No, I was looking at some of the stocks. So Bata India, there's Dish TV, we should actually put those names up. Crompton, Hexaware, Satyam, Union Bank of India, Yes Bank, Ashok Leyland. All are mid caps, of course, but there's no common thread in that sense through a lot of these names. These are all pure bottom up ideas, Manoj, or is there something top down here as well? I mean, is there a theme? No.
No. So yeah, I think you're looking at a mid-cap portfolio first, which is why you find all these mid-cap names. I think as you rightly pointed out, I think these are all bottom-up ideas. So for example, I think we like digitization as a big theme in India. I think over the next 1 to 2 years, you will see digitization playing out, and we think Dish TV is one of the best ways to play that theme. I think on the IT side, as I said earlier, I think we like some of the mid-caps. I specifically mentioned Satyam and Hexaware. I think both are part of this portfolio because we think these are two companies who will continue to deliver and where expectations are low. So this is entirely a bottom-up portfolio. And then you have in Bata, and they are again a company we think will continue to deliver. I think, and I think you mentioned this earlier in the interview, that what we've seen in the last, I think 6 to 12 months is companies who deliver numbers and who deliver clean numbers will continue to do well irrespective of the valuation. I think you've seen that in TCS, you've seen that in Bata, and I think that will continue. So our view is you focus more on bottom-up stories, you look at sectors, subsectors, companies which will deliver, will continue to outperform expectations, and these are the stocks that will continue to do well in our view.
I mean, so the other theory, which is that we are at an inflection point. If policy were to move and you need to buy some leveraged companies which are very sensitive to interest for you in that sense, or you want to get some does it make sense to get some exposure to those kind of companies as well right now?
Yeah, so Prashant, I think that's something that all of us have been waiting for, I think for more than 6 months now, right? And I think a lot of people who have gone down the path of buying a lot of interest rate sensitives have actually underperformed. I think our view on that is that if you build a portfolio now, some part of the portfolio has been towards high performing, probably more defensive names like the consumer names, cement names and all that. And a part of the portfolio has to be towards interest rate sensitives. But on the rate sensitives, our preference continues to remains for financials, basically banks or NBFCs. We are not in the camp that you should go and buy a lot of capital goods or infrastructure or real estate. I think those sectors at this point in time, one should not own. I think they are anyways late, they should anyways recover with a lag. We would rather want to stick with financials as a key way to play any recovery on the rates if it happens, right?
Okay, just to come back to the consumers, staples and FMCG kind of names, durables as well, Manoj. Going into this earnings season, and this is short term I'm talking about here, what do you think will happen? Would volumes start to disappoint a little bit? Last quarter, maybe one or two companies like a Nestle or an Asian didn't disappoint fully, but they started to show some sluggishness in their growth. Are we likely to see more of that with a lot of other companies? And then what happens to some of these stocks which are trading at all-time high PE multiples?
Yeah, so I think on a broad brush across the consumer sector, I do not expect disappointments. There will obviously be companies and pockets which might not do well. Like Nestle, you mentioned, Nestle's growth has been slow for quite some time now. It's not only a 1 quarter phenomenon. But I think if we go back, some of the companies like Lever, I think Lever should be okay. ITC might see a slowdown this quarter primarily because of what we have seen in terms of some of the excise duties and all that. But I think Lever should be okay. I think a number of the mid cap should be okay. I think Marico should have a good set of numbers. So I think, in fact, a lot of these companies will come with okay numbers. I don't think you can expect companies to report blockbuster numbers in the kind of economic environment we are in. But I think the key thing is, compared to expectations on the street, I expect more companies to surprise or meet expectations and disappoint in the consumer sector. And therefore, I think these valuations will hold up, at least till we start seeing real movement on the policy side or reform side, which makes people shun these names and go back and buy a lot of the beta names. I think that will not happen this quarter, at least not in terms of earnings.
Okay, got that. Let me just take a quick look at the pre-open rates. We've got firm values now, Manoj, just coming back to you. So We've got TCS, which is closed up 3% in the pre-open. That's the largest gainer expected. Let me just quickly at the same time look at Infosys, which is down 2%. That's another, 50 odd rupees down in the pre-open session today. So opposite ends of the spectrum, quite literally. TCS up 3, Infosys down 2, and the Infosys comes after yesterday's 8.5% cut. That's pretty severe. The Nifty is off, what, 0.25% or so. 52.41 is where it's left off. Sensex is up 40. That's 17,276. 9:15 we should hit the market opening in a bit. But it's, 35 up and 15 down. That's the tally on the Nifty 50 today. But the big noticeable gainers are just two IT names, TCS and Infosys, one up and the other down. The rupee as well. Let's just quickly pull up the rate there. 11-12 minutes into the market opening there. I think it's up a little bit this morning, 55.61 or so on the rupee against the US dollar. That's what's going on. There you go, 55.6150. Manoj, just wanted to get your thoughts on Hero MotoCorp, Bajaj Auto, and then Tata Motors and Maruti. Where do you stand on these four? Essentially, the big two-wheelers and Tata Motors and Maruti.
Yeah, I think the auto sector continues to see a slowdown. So I think if you look at basically the two-wheeler sector, our view is that you would see some slowdown, obviously. I think the bigger thing to watch out for two-wheelers is how the monsoon shapes up. I think if you actually get a decent monsoon, I think some of these stocks actually might start to outperform. I think two-wheeler in terms of financials, in terms of metrics, remains the best sector in the whole sub-sector within the auto sector. So I think if you see good monsoons, probably you will see something like a Hero MotoCorp continue to outperform. So we are actually positive on the name, because at this point our call is that the monsoon should be okay. So we like Hero MotoCorp. On Maruti, I think at this point in time we are largely neutralish. I think they are continuing to see a significant growth slowdown in the petrol side. And while I think diesel is holding up well, it's a significantly smaller part of the portfolio. So Maruti at this stage is largely neutral. I think Tata Motors, again, I think if you look at the news flow that we are getting from the global side, I think at the margin there seems to be more slowdown, and plus the Indian CV cycle is also weak. So I think even on Tata Motors at this price we are not very bullish.
Okay, got that. Manoj, thanks very much for your time. Great to have you with us on the show this morning. Appreciate your insights as always here on Profit. I hope to see more of you here on the channel. Manoj Singla there with his views on the market and of course what he likes and what he'd like to do in this marketplace. 2 minutes away from the market opening, and the pre-open is left off with a small change. TCS up and Infosys down. Infosys down now.